Hello everyone, Lee from Setters Property Finance here. Today we're diving into the key takeaways of the recent RBA decision, how the banks have reacted so far, and what it means for our mortgage and the property market. Before we get started, if you haven't already, please make sure to hit that like button, subscribe to our channel, and don't forget to turn on notifications. Let's get right into it. The RBA decided on Tuesday to keep the cash rate unchanged at 4.1%. Let's go over the key takeaways of Michele Bullock's first RBA rate decision statement as the RBA Governor. The statement starts by describing the economic outlook as unclear. And because of this, the board chose to hold the current cash rate at 4.1% to give them enough time to figure out how previous rate hikes are affecting the current economy. The thing is, although inflation has hit its highest point and it's come down a bit, it's still too high and will stay that way for a while. Recent signs show that the prices for things you buy in stores aren't going up as fast, but the cost of many services and fuel has gone up noticeably. Rent is also getting more expensive. The statement provides a forecast that overall inflation will keep going down and should be in the 2 to 3% target range by late 2025. The Australian economy did a bit better than expected in the first half of the year, however it's still not growing as much as it should be, and the RBA expects this trend to continue for a while. Prices are high, which is making it tough for people to afford things, and thus household spending is showing slow growth. The report continues to state that the amount of investments in new homes isn't growing as much, which is no surprise to us given the current borrowing and construction environment. The economy and jobs are expected to grow slower than usual. Forecasting predicts that the unemployment rate is likely to go up to about 4.5% next year. Not surprisingly, Michele goes on to say that the main goal is returning inflation to target within a reasonable time frame. She says high inflation makes life difficult for everyone and damages the functioning of the economy. It erodes the value of savings, hurts household budgets, makes it harder for businesses to plan and invest, and worsens income inequality. She goes on to say that to date, medium-term inflation expectations have been consistent with the inflation target, and it's important that this remains the case. I know it might be improper for an RBA governor to say this, but I wish just once the RBA would communicate to the public that reining in government spending can also be used as a tool to bring down inflation. But I guess squeezing the 35% of households with a mortgage in this country is an easier target. Like last time, the statement ends with a caution on the high level of global uncertainty caused by the property market crash in China. And that's pretty much it for Michele's first statement as RBA governor. So, what do I think about this decision and the statement in general? Considering the rise in fuel costs, I would not have been shocked if we saw an increase to the cash rate, considering how aggressive they have been in raising rates over the last year. I think we are most likely going to be dealing with these higher interest rates for a little while yet. And how have the banks reacted? I've gotten quite a few rate updates from lenders over the last couple of weeks, showing mixed results. One lender whom I would categorize as having higher than average rates reduced rates across their product line quite sharply, which didn't surprise me. One major lender increased interest rates slightly on a couple of their fixed products, while another major lender is reducing their fixed interest products quite substantially. And it's pretty much like this across the board. If there is a pattern, I'm not seeing it. As a part of my research, I like looking at consumer confidence metrics as it helps paint the picture of several things. It influences RBA rate decisions, it serves to tell us how people feel about the current state of the economy, it is correlated to consumer spending, and can even be an indicator of a volatile market when it declines sharply. Looking at the ANZ Roy Morgan Consumer Confidence Index, it was up 1.8 points to 78.2 this week. The index has now spent a record 31 straight weeks below the mark of 80. It seems to have gone sideways since we looked at it last in early September. So, not a lot of movement there at all. If anything, consumer confidence has slightly dropped. Cash rate and consumer confidence aside, I probably don't have to tell you guys this, but the property market still seems to be on an absolute belter. Despite 12 interest rate hikes, high prices and tighter borrowing, property prices just keep climbing. As we head into the spring selling season, our combined capital cities have gone up 4.9% this year. That's a big difference from the gloomy predictions made by many banks and experts at the end of last year. Even though there is an increase in the number of homes that are coming up for sale, the overall number of homes available is still low compared to usual. Guys, that's it for today's video. If you want a free home loan health check to find out if you're on the best rate at the moment, please feel free to contact me from the details below. I'll be happy to help you out. If you enjoyed the video and haven't already, please hit the like and subscribe button. It helps out the channel immensely. I'll catch you guys in the next one. Thank you.